I think everybody is trying to position themselves for the new reality, which is that the U.S. economy either already is or is rapidly approaching recession. I'm pretty sure that all the people who thought we were going to escape recession, we were going to have a soft landing, or if we had a recession, it was years in the future, and then a very mild one at that. I think a lot of people have now resigned themselves, including probably a lot of members of the FOMC, that the U.S. economy is either headed to recession or more likely already in recession. And so I think the markets are now bracing for that, which in some respects is considered good news, because a lot of people think that the recession is going to put the brakes on the inflation fight. And so maybe the stock market ends up benefiting from a recession if the Fed pivots and is no longer as aggressive in fighting this inflation. But I actually think the markets are still underestimating how bad inflation is and how bad the recession is going to be, and the fact that the recession is not going to provide relief from inflation. It's actually going to make inflation worse. Now, it's certainly possible that in the short run, you could see a temporary reduction in the inflation rate, so it comes down a little bit before it explodes even higher. But when this recession starts, it's going to be very bad given all of the leverage that needs to be unwound, and the rate hikes that have already taken place are enough to push the economy into recession, even though they're barely enough to begin, let alone win, an inflation fight. So we have more rate hikes to come. This is going to be a very severe recession. And again, if the economy is already in recession and unemployment is so low, imagine how much worse this recession is going to get when unemployment goes up. And remember, all recessions start with low unemployment. They end with high unemployment. Well, this recession is going to be here for a lot longer than most, and by the time it ends, unemployment rates could be setting a record. Now, the way we measure unemployment now, we may never beat the record set in the 1930s, because just like we no longer accurately report on the inflation rate, we also no longer accurately count all the unemployed people as being unemployed. So it's going to be very hard to officially match the numbers of the 1930s, although unofficially we could easily exceed the levels of unemployment that we had during that depression, in the depression that I believe has already started. And in fact, a lot of other markets are also providing evidence that people have shifted their focus from being worried about inflation to being worried about recession. We had a big drop in bond yields today. Why are bond yields dropping? Because people are anticipating recession. A lot of commodity prices have backed off considerably. We've had a big drop in oil prices. We're all the way back down to 104 for a barrel of crude oil. That's a pretty big reduction. We were above $120 a barrel last week, so a pretty big and rapid decline in the price of oil, as investors are anticipating a reduction in demand during a recession. Also, we're not seeing any movement in the gold market, even though people may anticipate that the Federal Reserve is going to be less aggressive in fighting inflation because the recession is going to do its job for it. We're not seeing people buying gold. I mean, they're not selling gold. Gold's still hanging out around 1840. It's still slightly positive on the year. That's about where it ended last year. We're just a few bucks higher. I mean, gold is holding up better than just about every other asset. And in fact, in other currencies, gold has gained because the dollar is up quite a bit on the year. And so that means the price of gold is up quite a bit in other currencies. So gold has done an okay job so far in 2022, especially relative to other assets, but it hasn't done what I anticipated it would do, because investors still don't understand that this recession is not only not going to cure inflation, it's going to make the inflation problem worse. When they figure that out, the price of gold is really going to take off. But in the meantime, because they haven't figured that out, look at how weak gold stocks have been. In fact, gold stocks had a very weak day today, much weaker than the overall stock market. In fact, year to date, despite a slight gain in the price of gold, the GDX, which is an index of major gold producers, is down about 6.25% on the year. And the GDXJ, which represents the junior miners, is down 14%. Now, I think what happened is a lot of people who bought some of the gold stocks because they correctly anticipated inflation would be a problem. Well, now that it is a problem, they're looking to take profits, and there's not a lot of people who want to take the other side of that trade because people are not worried about future inflation. They're worried about the Fed fighting inflation, which they think is bad for gold. And they're worried about the Fed winning its fight against inflation, having a recession. And so there's no need to worry about inflation in the future. So there's no need to buy gold stocks today as a hedge against future inflation, which isn't going to exist. But again, the market is completely wrong on this. And this is what opens up the opportunity for investors who actually understand what most investors are still oblivious to. But when it comes to market volatility, since my last podcast, nothing tops what happened in cryptocurrencies with Bitcoin, with Ether. We had a huge crash over the 3-day weekend. In fact, it was a slow motion crash. It wasn't one of these collapses where Bitcoin dropped several $1,000s a coin, in 1 or 2 minutes. It was just a slow and steady decline over most of the weekend. In fact, I think we bottomed out on Sunday and then we had a rally. But the low that Bitcoin got down to was 17,800, something like that. When I recorded my last podcast, Bitcoin had rebounded from not quite touching 20,000 back up to 22,000. And you had a lot of people that were confident that that 20,000 number was going to hold because that was the high from 2017, and so people thought that that old high would be the new support. In fact, during the whole 11 or 12-year history of Bitcoin, it has never gone below a previous peak. So every time Bitcoin has made a peak and then sold off sharply and then made new highs, the correction has never brought it below a previous peak until now. So Bitcoin has just done something that it's never done before, and that should be a wake-up call that maybe the game has changed and we are now in the permanent bear market for Bitcoin, that if you hold and hope, Bitcoin is not going to come back and make a new high. And I was certain that when it left that 20,000 intact, that it was going to take it out. That even if we were going to have a meaningful short-term bear market rally, that at a minimum, we were going to have to take out 20,000. And sure enough, we did. We even took out 18,000. But then we rallied back. By the time the U.S. stock market opened for business on Tuesday, not only was Bitcoin above 20,000, it was above 21,000. And again, a lot of people in the Bitcoin community were very confident that the bottom was in. In fact, CNBC spent the entire day trying to convince its audience that the lows were in, that it was still a bull market. They had one guy on there, and I'm not making this up, he was saying you got to buy Bitcoin because it has proven itself to be a long-term store of value. How has it proven itself to be a store of value? It's just collapsed 75%. I mean, if it's going to go down by 75%, it's hard to say that it's proved that it's a store of value when you've lost 75% of the value that you wanted to store. The guy who takes the cake is Michael Saylor, who continues to go on every podcast that will have him, no matter how small the audience, to brag about how much money he's making in Bitcoin, what a great decision he had to buy Bitcoin, even though he's down like $1.5 billion. He's down over 30% on his average cost, which is over 30,000. As I'm recording the podcast today, we're just below 20,000 again. We're about 19,900. So it was a horrible decision to put Bitcoin on the balance sheet of MicroStrategy, yet he claims it's the best investment he could have made. He's still claiming that buying Bitcoin was the best thing that he could have done with MicroStrategy's money, even though he's down over 30% on his investment and he borrowed a lot of the money. So not only is he down what he lost, but he's down the interest that he's paying to borrow the money that he lost. Now, sure, he got a low rate of interest, but how is that any consolation when what he bought with that borrowed money has dropped by better than 30%, and it could drop a whole lot more? There is significant downside risk now in Bitcoin. The chart looks horrible. The fundamentals are horrible. This whole thing is blowing up. And what we haven't even had yet, in my opinion, are the mass liquidations.